welcome back to REI Hot Seat.
The hot seat.
That's it, with Dave
with
and
the
Jake.
investments group.
With the
we better iron
investments
that
group.
out. Is he the investments group or Dave and Jake?
Dave and Jake.
Oh,
like it.
welcome to the hot seat with Dave and Jake.
There we go. All right, so Dave, last week I know I mentioned we had some big new deals. And so this is one of them. This is a new listing that's going to be coming on the market. We are in the process of finalizing underwriting, building the data room, doing all the good stuff we do. We're going to show the performer, we're going to show the rent roll today. Things are subject to change.
Yep.
As we get the data room built out, there might be minor changes, but this is pulled from actual data. So again, we shouldn't see any material changes, but there might be minor changes. So if you do inquire about this, don't say, hey, chick, what the heck?
Yeah,
right?
It's a work in progress. We're bringing it to the audience a little bit early, which I think is a great move.
Yeah, right?
So just for context, your listing, right?
This is going to be my listing. We're working, like I said, we're working on it right now. Paperwork has been signed, and we're kind of in that gear up stage.
Got it.
So it's perfect time to bring it out to people. They can comment, they can call us, ask questions about it, and we have the answers.
Caveat, the little bit that I know about this deal, I love it.
You like this deal, yeah. So I am going to let Dave kind of riff on it for a bit, but let me go high level here with it. So the deal is 62 units in 2 different apartment buildings.
Yep.
So we have 2 buildings. They're 4 stories each. They were built in, I want to say 2019 and 2020.
Yeah, they're new, basically.
Yeah. So end of 2019, beginning of 2020. So right off the bat, we don't have rent control in these buildings. Good to note, right? You'll see that the rents are market. Mm-hmm. This is a I would call this a long-term wealth building investment, generational wealth investment, right? This isn't a quick value add, but it is a very nice asset to have in your portfolio. So,
and where's the location?
So location is Ayr, Ontario. So Ayr is located just, I want to say, southwest of Cambridge.
Yep.
So it's a smaller community, but it actually has a very high household income.
It's a very wealthy pocket.
It is.
Yeah.
Extremely. Do you remember what the income was? I know you looked it up.
I think this was a while ago, but I feel like it was like 110 or something. We'll check it out and put it in the
much
comments.
higher than like KWC combined. Right?
Like staggeringly high, like up to kind of pretty damn close to Burlington, Oakville levels. Yes. Like you look at it and you're floored.
And it's a beautiful little town. Like, not that this has any bearing on the building, but I drove through the other day with the fall colors coming in.
Oh, it
and
matters.
I was like, oh, this is cute.
Yeah. No. It's like I would be absolutely comfortable living in Ayr.
Oh yeah. No, it's nice.
Yeah.
So anyhow, so these buildings are just on the main thoroughfare from Cambridge into Ayr. You really can't miss them. They're beautiful buildings, and so again, new builds, elevators in both, and it is coming with CMHC debt on the building. So we'll work through it quickly. I'll just kind of show you what we're dealing with here. So a nice mix of 2s and 1s. It's almost 50-50 2s and 1s.
Okay, love it. And the ones, what are the size on them?
So 1s are ranging, so again, new builds, so they're not all exactly the same, but we're ranging anywhere from, call it, the smaller units are 550 upwards of 650.
Yeah, so no Toronto micro 1-bedrooms.
Yeah, like
these are good
for
size.
example, this unit here is a 1-bed, so it's 711.
Oh, wow.
Right. So a bigger 1-bed, right? And then the 2s go anywhere from 800, and I think there's 1 or 2 that are almost 900 square feet, 2 beds.
Oh, so it's large.
So, and it's condo grade. Like, you go into these units and it looks like a condo, right?
Yeah, like when I went through them, I thought condo.
Yeah.
Like you really pretty much are condo.
Yeah, they're all separately metered. Each unit has its own furnace, again, like a condo, right?
Love this.
So very nice management, very clean, very low expenses.
So the hydro's metered?
Hydro's metered.
Okay.
Water's bulk.
Okay.
Gas is bulk, but all individually controlled.
Beautiful.
Which is nice. So we'll go on to the Forma here. So again, I ran this Forma as I usually would for a listing. So it looks different than Dave's Forma, right? Dave has the buying Forma. So he's diving into all the little nitty gritty of the building. And Dave will do that Forma for this building as well. But my job in our partnership is I package it like this because I'm going out to the public. So that's what I'm going to show you guys today. But you'll see. So gross income, $1,441,000. We've run a 2.5% vacancy rate on the building. To be very honest, that's actually high for Ayr.
Okay.
So but I'm using CMHC data, and unfortunately CMHC data is not, it doesn't have Air Ontario because it's too small of a population. So I have to go to Cambridge, Kitchener, Waterloo, which does have a slightly higher vacancy rate. So we're
don't
going
mind
from
cushions, you know this.
Well, that's it, right? So we're going from, call it, a 2% vacancy to a 2.5. Not that big of a deal. We have property taxes from 2025, so 85,000. We have insurance, 51. Repairs and maintenance, running the CMHC standard of 830 a door.
Yep.
You're sitting again 51, so same number there. Salaries, again, we're running a guideline number because this is how the bank wants to see it. This is how most people are just standardizing their performance these days. But it is pretty darn close to how the building's operating. Like I would say within dollars. It's really, really close. So salaries, we've included in there landscaping, snow removal, hallway cleaning.
You're using kind of CMHC.
Yeah, I'm using CMHC data, but then I always cross reference the CMHC numbers to actual numbers.
Yes,
and they're always very, very close.
Yeah, arguably on a building like this might be high.
They might even be high.
Obviously, it's an incredibly efficient building if to the newer side of construction. Like I'd be curious, you might not have it on there, what the OPEX is as a percentage.
I was just about to go there with it. So
you and I do a lot of business together.
Saving everybody the spiel to go through every single of the line items here. But one thing that we have added in addition, which you wouldn't usually see, is an elevator contract, right? So CMHC requires that we add elevator contracts separate to reserve maintenance fund and all of those items. So that's 14,000 a year. That's for both elevators. Okay. So keep them running, keep them operating there.
During the due diligence phase, you'd want to get a copy of that.
Absolutely, right? So total op expense on this building, 26%.
Yeah, that makes sense.
You're kind of sitting above a townhouse, but under, call it, like a traditional walk-up building.
Yeah, like if you told me it was 35%, I'd tell you we need to fix those numbers.
Yeah, and we've talked about this before on the podcast, like 35%, that's usually what you're expecting on, call it like a 1960s, 50s, 70s concrete build, 3-story, 4-story, whatever, right?
Yeah,
it's just
with good rents.
Yeah, with good rents, right? So it's just things tend to break more often, right? You're accounting for more. But when you get into these newer builds and this higher unit count, because now you have economy of scale, you're going to see that number shrink a little bit. So we're sitting at 26%. I'm very confident with these numbers. I've gone over them several times, and I can argue that this is actually more than the op cost.
I would not be surprised at that.
But we want to build that buffer. We want people to see, hey, everybody manages it slightly different. And that's my hesitancy with actual numbers. Is everybody manages these buildings slightly different, right? And contracts that are going to be assumed, great, we can run those at actual cost. But when it comes to R&M and salaries and management, that's where it gets a little bit tricky, right? You and I've seen it enough. There's listings on the market nonstop where they don't have any management, right? Why didn't you put management? Well, because they self-manage, right? But I'm not going to self-manage. So,
and it needs to be in there. Like it's just a safety feature. Anyway.
It's just one of those things, right? Like even if you're self-managing, pay yourself that money.
And I use it, as you guys know, I use it as a filter, right? So it's like if I don't include it on this and I include it on this, it's just confusing. I use the same filters variables on all the deals, and then we work our way from there.
And honestly, if you look at any of the big guys' listings, they're all doing the same thing, right? Everybody I've seen, every building I've looked at from all of the big commercial houses, they all run it with CMHC numbers. It's just the golden standard these days, and it's great, right?
And so this has assumable debt on it?
It does. So we'll jump over to that right now. So asking price on this is going to be $23 million. Okay, that puts it at $370 a door for 62 doors, and it puts it at a 4.5 cap. Okay, so right off the bat, you might be saying, the numbers don't look that great, right? Like $370 a door, I have no issue with. It's a new build, condo grade. The 4.5 cap, people might have a little bit of a gripe with that, but we're offsetting that by assuming really solid debt. So we have 85% loan to value of the asking price.
At 23?
Yep, at 23.
Okay.
So we have $19,560,000 of debt, assumable debt, first position.
Okay.
That has a 37-year AM left on it.
Love that.
This is the one thing we're still ironing out right now because there was that interesting clause in the commitment. But my understanding is there's 6 to 7 years left on this property for term.
Fantastic.
So you still have a nice long runway. It was a 10-year term originally.
Yeah.
And you're taking that at 2.8%.
Yeah, we love that.
So that's where this thing really starts working, right? Because you're
Love that.
You're taking this debt over no matter what. It's great debt.
Yes.
2.8%. You have that for another 7 years.
So we're 85% LTV
85% LTV
at purchase.
at purchase.
And we're at a 1.2 debt cover.
A 1.22 debt cover. Yeah.
Wow.
Yeah.
Well, it's interesting. Last week we talked about, hey, we're going to take on a VTB. Now I understand this is interest only, but at 3%,
Yep.
that's a no-brainer.
Yeah.
So this is the same thing, except it obviously doesn't have interest only.
Yeah.
But you're still over a 1.2 debt cover, and you're taking it at 2.8%.
2.85. Yep.
Fantastic.
So 2.85. So you're just locking yourself into a great deal. That gives you plenty of time to watch how the market develops and unfolds, right? Because I think that's the biggest hesitancy people have right now is where is the market going to be in 1, 2, 3 years?
Yes.
Anything outside of that 1, 2, 3 year timeline, nobody's going to know, right? So it's like, okay, you're hedging your bets. You're believing in Canada. You're believing in real estate in Canada. You got 6 years, call it, at 2.8%. Like,
it's interesting.
You can let it
look
run.
at like inflation, right? So they use the CPI. So they have a basket of goods. And it's a huge debate, but like those are probably inaccurate numbers to the sense that the inflation that we're telling us it is actually lower than what the reality is.
Right.
Okay? But even if you take that, let's say it's 3.5%, you're going to get debt at 2.8, right? You're already winning.
Yes.
Day one.
Yeah.
So, I say this loosely, but it's like, that's free money.
Yeah.
It really is.
Yeah.
So you're getting this debt with basically no negative implication other than you got to make sure you support it.
Yeah, that's it, right? So, acquisition costs. So what are you paying to buy this building? You're going to be sitting at what, $3.5 million to buy the building, $4 million, call it. You get about $190,000 a year cash flow. So I don't have the return. I don't have the cash on cash return. That's the only thing I didn't do.
You need $3.5 million to buy 62 condo grade units that is cash flowing positive easily for the next 6 to 7 years.
That's it.
Yeah, the power of this, though, is the immense amount of leverage you can get, but leverage at quality positions, like not putting yourself in a, we saw this, you probably don't follow the crypto as much, but like we saw people get absolutely decimated because they were doing 2-3 times leverage positions, 100, 200, 300%, and the market tanked and they lost all their money.
Well, we don't even need to look at crypto for that. You can look at the real estate market, right? Like, we've talked about this numerous times. There's a lot of people that are that took a 95% LTV CMHC MLI position, and it's backwards now. They're underwater, right?
A lot of them, man. A lot of them are underwater, and that's the thing is these foundational ones. We run the sheet at 85% LTV, 1.2 debt cover. People say, hey, if we do MLI, can I do this? Yeah, you can, but like let's make sure the deal works this way.
Yep.
And it does, and you can go and take $3.5 million and buy 62 condos and cash flow positive. It's beautiful. I get excited. That's why I get excited about this deal. We haven't looked at mortgage pay down. We haven't looked at 2% increases. The actual R&M on this building will be way below, I'm sure, than what what you and CMHC have in there because it's new.
Exactly. So, all in all, very different product than what we talked about last week. Different buyer profile.
Yep.
Right. Who's buying this? Going to be small funds, wealthy individuals, family offices, REITs, etc. But again, I think it's a great asset in a market where there's low vacancy and a good return.
This is patient money.
Yeah.
It's like as you start to remove variables, the likelihood to success increases. Yeah. Right. So if we say, hey, well, I want to value add a beat up building, but I can 2x my money if I do all these things right. This is, hey, if you get this, you put good property management in, you're aces. You're good.
Well, that's it. Like you can look at this and say, okay, is this an alternative to stocks and bonds investing? Is this an alternative to, maybe not crypto, maybe crypto? I don't know. I'm not in that market like you are, but that's how I would present this more so than a value add, than a hey, flip it and do this and add this and this is here's the return on your money, $3 million in, 190 out. And then you can look at the 3 ways to win kind of thing, right? Where you can say principal, pay down, appreciation, et cetera, et cetera. But I would sell somebody just based off the cash on cash return and then say everything else is gravy.
And to kind of circle back to the last point, cap rate at purchase, 4.5, but you're also buying that up effectively because you're getting such good debt.
Well, that's exactly it.
Right? Like if you didn't have this debt, you had to get new debt, you'd probably be right around that 5-ish cap rate.
Yeah.
Would be my guess on the listing.
That's where I would, more or less, that's where it would
So
be.
now you get quality debt below, what you're going to go get on your own, probably by 100 basis points at least.
Yep.
Right. So yeah, this resonates with me. I love this stuff.
Yeah.
So you got the listing. People are interested in it. Is it too soon? What do we do?
Yeah, listen, anybody can acquire in this now. We're going to build that list. So if you're interested in it, reach out to us. You have, the insider list below. You want to throw a comment, like this video, give us a thumbs up, do what you need to do. Yeah. But yeah, reach out. Happy to get you some preliminary information. Start having conversation about this property. We have rights to start marketing. We're just trying to finalize all those numbers, and there's a couple pieces of information I'm waiting on still. So I would say within a week's time from this episode launching, we're going to be in a position to go to market and get this sold.
Yeah. So by the time this comes out, we'll likely have the data drive ready for the most part. So we'll get you access.
Awesome.
Love it.
That's another one, Dave.
Hey,
two down.
2 for 2.
Yeah.
Like, subscribe, comments. We're getting a lot of information from a lot of different sources. Questions of the week. We're doing a lot of intake calls for buyers, but we're also getting a lot lately of people wanting to understand what their building value is. It's been an immense amount of change over time with, ups and downs on people just not sure where their building lands. And we're doing no obligation. We'll let you know what it's worth. We'll do the rundown we always do. VTBs, all these fun things, what we feel we can get. And a lot of people right now don't want it on MLS, but they want to send it out, and we can do that. We do a lot of that, as you guys know. So reach out, let us know how we can help, and we'll book a call.
Awesome. We'll see you next week.